Hey patrons, happy Monday. I'm here with a bonus video for all of you. I want to welcome all the new patrons because there's a bunch of new patrons who came over recently when I posted that video on YouTube introducing everyone to my Patreon. So thank you for doing that. It means the world to me. I'm really looking to grow the community here on Patreon. And I do have kind of that dream in the back of my mind that one day all of this on YouTube becomes more than just a hobby or side hustle and becomes something even bigger. And so I really appreciate your support along the way. Today's video, you can actually thank Patreon community member Joe. He actually was asking me about this. He wanted to learn more about my yield on cost and how that compares to current yield and how my cost basis looks, whole bunch of questions like this. And I'll tell you, before I even get started in the video today, one of the things that's been a challenge for me in dividend investing over the year is keeping my records. I've been working a lot strategically in 2021 on record keeping, but because I make so many transactions and because I own so many stocks, sometimes it's difficult to keep all of these records in real time. And sometimes I have to prioritize for myself. Ian, do you want to do videos or do you want to keep records? Ian, do you want to go out, do your job, earn more money, or do you want to keep records? And oftentimes it's like, Ian, do you want to exercise or sit at the computer and keep records? And sometimes keeping records, it just falls behind. And I have kind of been in this mind state that, Ian, you're relatively young. You're in that time of your life where you're kind of going out there trying to gather as much money as possible. And there's always going to be more time to kind of update your books, update your records. And thankfully, most stockbrokers and platforms these days keep pretty good records, but quite frankly, I like to keep my own as well because I like to analyze the data. But anyways, that's where I'm at. I don't know if any of you are out in the community are like that as well. If you are, please put in the comments below. I'd love to hear. But I'm just being honest with all of you out there. That has been one of my challenges, is keeping really good records. Yeah, I have historically, but it's fallen apart in the last few years. And also just as a father of two kids, family man, married, there's a lot going on with our family. And so if I'm going to go out on the weekend and practice baseball with my son or keep records, again, it's just tough. And so that's a conundrum that I'm in, but I have been working on it. And I want to share in the video today some of my cost basis information because I have been updating some of my records and I'm getting through them. And so I don't have this for all of my stocks, but I have it for some of them. And I think what I have is good enough to share a message and to answer Joe's question. So thanks, Joe. And by the way, everyone, it is just a Patreon video, but if you are able to smash the like button, it does help out. It just makes me feel good more than anything. And so do that. If you can, it really means the world to me. And without further ado, I want to share my analysis today. So check it out on the screen right now. And so this analysis goes through 11 stocks, I think. These are 11 that I was able to pull pretty good records on. And so, yeah, I have 50. I have a lot more to go, and I'm kind of, I'm getting there. I think at this point, honestly, what I'm going to do is just try to attack or kind of conquer one stock per week or something like that and just keep going. But, basically, even before I get into what's on the screen, typically what I do is I have my own Excel spreadsheet, and I have a classification method where I look at stocks a little bit differently than the brokers look at them. What's most important to me in terms of cost basis for understanding my true performance is basically how much money I put in, like real money, and when I bought shares. But when dividends are reinvested, the way the broker looks at that, it does look at it as a cash transaction because cash is paid out, and then technically the investor uses that cash to buy more shares. And so there's a cost basis associated with it, as there should be. And that actually benefits the investor for taxes, establishing the basis. But basically, that's how the broker looks at it. But the way I look at it, quite frankly, is a little differently. When I get a dividend, I look at that as free money. I look at that as, I don't look at that as net new cash I'm putting in. I look at it as free shares. And so I'm going to look at it both ways today. But as you can see on the screen right now, the first table, this is the way the broker historically looks at it. And so this is looking at it as tax yield on cost. And so I would say this understates the true results since tax cost basis is used. And so again, when dividends are reinvested in this first table, it's looked at as a cash infusion, a cash investment. But again, we all know that dividends, it's free money. I shouldn't say free. We work so hard to build these positions and put our money into dividend stocks. But those dividends, that's the passive income. That's the passive part of it all. And so I don't look at that as working cash put in to generate more cash. I look at that as cash flow cash, earning more cash. So anyway, the first table, because of those reasons, understates the results, but I actually think it still gives a really good direction of what Joe's was looking for. And so I'm going to go through these stocks. First one is AbbVie. And so the current price is $107.91, and my cost basis was $72.52. Now, when I say cost basis, this is my cost basis on all tranches that I bought and on all dividends reinvested. And so it's my total cost basis. First time I've ever shared this, I think, on the YouTube channel with anyone, and that's why I'm doing it here on Patreon, because you're the ones really supporting what I'm doing, and it means the world to me. So let's keep going. Check it out on the screen. And so on AbbVie, I'm up 48.8% on my total cost basis. And I first started buying this in 2019. And so 2 years have elapsed. I have the years elapsed because Joe wanted to kind of understand, Ian, what does your yield on cost, what do your results look like over time? And so I saw it on years elapsed, but what's so interesting is actually it's a little haphazard. I don't find a strong correlation on these stocks, at least, between years elapsed and results, because some of the ones I owned even shorter amounts of time have honestly performed the best. And so, but technically, or traditionally speaking, over long periods of time, I expect more years elapsed, better results. And I'm sure on some of my really core ride or die stocks that I talk about all the time, you're going to see that kind of relationship. But anyways, I include years elapsed because Joe wanted to see that, and I thought that was a good question. Now, you can see I have dividend information here, and I have the current yield. The current yield on AbbVie is 482. But what's my yield on cost on this kind of tax basis cost? Well, if I take the dividends per year, which is $5.20, and I divide by my cost basis, which is $72.52, my yield on cost is 7.17%. So on AbbVie, after owning it for 2 years, from a tax basis yield on cost standpoint, the delta is 48.8%. So what this means is by holding this thing 2 years, and it's not all tranches 2 years, but since my first tranche 2 years, I'm able to enjoy a yield on cost that's almost 50% higher than someone just starting out and buying the stock today. And the reason for that is the fact that I've been reinvesting dividends, that they've been growing the dividend over time, and quite frankly, because I bought at low levels as well before it had run up. But presumably, even right now, I think AbbVie is at low levels, in my opinion, so I think it could continue to run up over time. And so this, I hope, gives just a flavor of what's possible with dividend growth investing. Check it out on the screen right now. I want to go through the next one. The next one is Apple. And so Apple, I have been in this stock for 3 years. I'm up 195% on my total cost basis. And from a dividend standpoint, the current yield is really low. It's only 0.61%, but my yield on cost is 1.8% on a tax basis cost. So my delta is 195%. And this gives a sense of what's possible with a faster grower, with a really quick grower, with a high growth stock. And so for me, one of the reasons my portfolio is a well-rounded team, I have stocks that aren't growing really quickly because they give me a lot of current yield, but I have stocks that are growing really quickly like Apple, because if I can hold them over long periods of time, the yield on cost is really substantial. And I'm just getting started with Apple. I'm just getting started, but I'm really happy that most people look at Apple and they just brush it aside from a dividend standpoint, but I'm actually almost earning 2% yield on it, which is pretty good for a name like Apple. Let's keep going. Check it out on the screen right now. And so I next have 3M and Starbucks. I highlight those because I have a true yield on cost analysis on those as well that I'm going to share later in the video. But I just highlight them because those are two stocks I was focusing on very much last year in 2020 and that I love. But I've been in 3M for 3 years, Starbucks for 4 years, and basically, you can see with 3M, this one's a little bit of a different case because when I first started buying this company, I was buying it well over $200, and I put a lot of money into it, over $200. And that's why my cost basis is only $172. My cost basis, you would think it would be lower because I bought so much last year at low levels. But actually, when I first started buying it, I overpaid, I guess. And so this is actually one of the benefits of averaging down. Even though I started out overpaying, well, now I'm up 15% almost. And so that's really cool. And you can see that from a delta standpoint, I'm 15% higher my yield on cost versus the current yield. And as you can see with Starbucks, this was a home run for me. I'm up 80% on this stock, and I've only been in it for 4 years, and my yield on cost is actually 80% higher than the current yield. So current yield is only 1.52%, but I'm yielding almost 3% on Starbucks, 2.74%. And so that's what's so powerful by buying stocks at value levels and holding them and adding to them and enjoying the dividend growth. But even with something like 3M, again, I bought at really bad prices, but time is kind of the great equalizer, especially when I'm buying high quality names like 3M. And yeah, I overpaid in the beginning, but I made a wrong, I guess, into a right by averaging down, and that has paid off really well. Next one is Colgate. Now, Colgate is a example that this stock has been really slow to grow. Really slow. I've been in it for 6 years, but I'm only up 20%. But quite frankly, I think it's going to do well over the long run. And in fact, I started reinvesting dividends on this one again, even though I hadn't been reinvesting dividends. And I like that fact that they have really good international exposure and the lion's share of their business comes internationally. But again, I include a variety of different stocks in the analysis today because I'm trying to show all the patrons what is possible. There's really good things like Starbucks. There's okay instances like 3M and Colgate, and I'm even going to get into a bad one where I'm yielding on cost lower than the current yield, and you'll see that in a minute. So check it out on the screen. And so anyway, with Colgate, my delta is only 21%. I'm yielding 2.7 on cost, and the current yield is 2.23. Next one is BP. This is an example where my cost basis is $35 almost, and it's trading at $25. So I'm down over 7 years by almost 28%. This one's been a loser for me. And you can see the current yield is about 5%, but my yield on cost is actually only 3.61%, and that's because they cut the dividend. And so, yeah, I put a red box next to it as well. This is one that hasn't done so well for me, and I have to be realistic. Now, at the bottom of the table in yellow, you'll see I do a simple average on everything just to give a flavor of, well, what's possible overall averaged out. But yeah, I've got a loser in there. Next one is a clear winner, Air Products and Chemicals. This is, I would say, what people really talk about when they talk about dividend growth investing. I've been in it for 8 years. I'm up 218%. And the stock only yields right now just over 2%, but I'm yielding 6.66%, which is 219% higher than the current yield, and that is actually the tax yield. And so my real yield on cost, not including the cost basis of reinvested dividends, it's even better. But hey, I'll take it. And so Air Products and Chemicals, I think it's one of those stocks that's just got a lot going for it. Not necessarily right now, but when I bought it, it was undervalued. It's growing quickly. It was being disrupted. There was a activist investor who came in and kind of shook things up. They were raising the dividend quickly, and it all kind of snowballed. I think that is a perfect example of the dividend snowball with Air Products and Chemicals. And I love companies like that. Anyway, let's keep going. Check it out on the screen right now. And so the next one is Leggett Platt. This is one I'm not as excited about anymore, but hey, I'm doing all right. My cost basis is down at 31. It's at 48, so I'm up 50%, 55% almost. Been in it for 8 years. The current yield is 3.28. My yield on cost is 5.08, so 54.95 better yield on cost than what someone gets by just buying right now. Next one, Norfolk Southern. This one has just been a home run. I never expected it to do this well, but I've been in it for 8 years. I'm up 200% on my cost basis, and that's overall cost basis, all tranches, including reinvested dividends, so it understates the performance, quite frankly. But the current yield, I'm at 4.39%. Current yield is 1.46, so I'm up over 200%. My yield on cost is better than the current yield. And this is, again, an example of why people love dividend growth investing, including myself, and why current yields, sometimes they're a little misleading because people think, oh, you're just buying into this low yield. Norfolk Southern, honestly, it's never had a good starting yield, but I knew that they could grow the dividend over time. And I think a lot of people miss out on really good stocks because they think sometimes starting yield is too low. But as long as the stocks can continue to grow the yield over time, that's the benefit of yield on cost. Let's keep going. Check it out on the screen right now. And so the next one is Altria. And Altria, surprisingly, I'm only up 67% overall. And this has been one that, my first tranche yield on cost, it's out of this world. It's over 20%, but I bought a lot more tranches over the years. I've averaged up. And so I've been in this 12 years, but I'm only up 67%. And so the current yield is 6.58%, but my yield on cost is 11%. And so still, honestly, you could say it's not that exciting to be only up 67% in 12 years time. But again, it's not 12 years for all tranches, 12 years since my first tranche. And I've waited a lot of tranches later throughout those 12 years as my earning potential has gone up over my career. But What excites me the most is the 11% yield on cost, and that's 67% better than the starting yield. And so another one is Philip Morris PM, and this one I'm up only 12% over those 12 years. But what I would say of Philip Morris is I got some really good tranches at the beginning when it was really cheap, but I averaged up in this one quite a bit at levels similar or even higher to where it's trading right now. So that brought my overall cost basis up. That's why I'm only up 12% over all these years, and I'm only doing 12% better yield on cost than the current yield. And so what I learned from some of these things is sometimes, honestly, as dividend investors, we just need to look at the data. We need to look at the data because sometimes in our mind, we think that we're doing better on something than we really are. And sometimes in our mind, we're thinking like something else we're not doing as well. Like Norfolk Southern, quite frankly, I didn't know I was doing quite as well as I was before looking at this analysis. I didn't realize my yield on cost was over 4%. But with Philip Morris, I didn't realize, oh my gosh, I've been in this thing now going on over 12 years, and I'm only up a small amount. That being said, I think there's a world of promise for Philip Morris. And also, I don't want to discount the fact that I've been receiving all these dividends over the years. And more recently, I'm taking my dividends from Philip Morris, reinvesting it into higher growth companies more like air products and chemicals, the future air products and chemicals, that is, like companies like Utz Brands Inc. And so that it all plays a role. They all play a role on the team, if you will. And so I would say out of everything I shared today, I'm actually really happy with my performance on everything except BP. But anyway, check it out on the screen right now. Let's just look at the simple averages. And so over a 7-year period of time, which is the simple average here, what did I earn? 80+% gain on capital appreciation. And on a yield on cost basis, I am, and quite frankly, that's not... yeah, that's 80% capital appreciation. It's a little weird, again, just because it's this tax basis look. But yeah, on a yield on cost basis, I'm up 52% better than the current yield. So just by being in the game, having a broad portfolio of dividend stocks for 7 years, which is the example of the sample size of stocks shown here, 52% better yield on cost than the current yield. And that's just 7 years. Imagine what it'll be in 30 years or 40 years. And so that's what's so exciting about dividend growth investing. Now I want to show, though, what really happens when we look at it as free dividends. If we don't look at tax basis of the dividends, we just assume those are kind of free money. Check it out on the screen right now. And so you can see the table on the bottom, which includes 3M and Starbucks. What's so exciting here is now you can see my yield on cost. Well, first, my gains are even better. So 3M, I'm up 22% instead of 15%. Starbucks, I'm up 89.6% instead of 80%. Because again, that dividend income, that's not net new money I put in. That's money that the company produced that I put back in. I look at that as free money. So my gains are higher. Now, what I also like to show is my yield on cost is higher. It's actually 22% higher, or it's a 22% delta for 3M instead of 15, and it's an 89% delta for Starbucks instead of 80. And so it's really, and I show a delta versus the first table above. It's 6% better on 3M and 5.14% better on Starbucks. And so again, what's so exciting is yield on cost here for Starbucks, 2.88%. That's getting really close to that 3% range. And so again, I would say that looking at things these ways gives a really good perspective on dividend growth investing. It underscores the importance of keeping good records because honestly, it doesn't matter whether I keep good records or not when and if it ever comes time to sell. And again, I don't plan to sell, but you never know. If I do need to sell, the platforms, the brokers, they keep the records, and so they're going to keep the cost basis. But what's more important about keeping records from my standpoint is having a backup, because I like to sleep well at night knowing that I have a spreadsheet with everything in one place, but also just analyzing the data, because when we analyze the data, it makes us smarter investors. And it kind of puts me in tune, like, hey, I own 50 stocks. I got all these stocks. They all play a role. But Ian, 2021, your goal has been around growth stocks. And Ian, I knew intuitively why I was getting there, but now the data helps back it up even more. That sweet spot that I need right now are more stocks like Norfolk Southern and air products and chemicals. And that's why I've gotten into stocks like Utz Brands Inc. That's the sweet spot that I need because I have time in the game. I want to see the dividend snowball work. And so stocks like Philip Morris, for example, there's not much of a snowball, but it sure provides a lot of good current yield. Stocks like BP obviously didn't go as according to plan, but I have enough stocks in there like Norfolk Southern, Apple, Air Products that did exactly as they should. That kind of points me, when I look at all this data, yeah, what I'm doing in 2021 is the right strategy and I want to do more of it. At this point in my investing career, do I want to put more money into Philip Morris or Altria? Not necessarily. If I were just starting over, would it make sense? Yeah, they're good foundational stocks potentially that provide solid cash flow that could be reinvested into other stuff. It just gets the cash flow going. So they play the role. But I'm just saying, now that I have all these team players and I look at all the data, I'm kind of headed somewhere else. I'm headed towards more of the total kind of dividend growth, classical dividend growth stocks. And I think AbbVie plays into that mix really well. I'm really excited about AbbVie here. Anyway, I hope you enjoyed the video today. And before I leave, in terms of a full disclosure, I am long all of the stocks mentioned today. I'm long Utz Brands Inc., ticker UTZ. I am long 3M, ticker symbol MMM, Starbucks, ticker symbol SBUX. I am long AbbVie, ticker symbol ABBV, Apple, ticker symbol AAPL. I am long Clorox, ticker symbol CL, BP, ticker symbol BP. Air Products and Chemicals, ticker symbol APD, Leggett Platt, ticker symbol LEG. I am long Norfolk Southern, NSC. I'm long Altria, ticker symbol MO, and I'm long Philip Morris, ticker symbol PM. Also, before I leave the video today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on Patreon and on YouTube for fun and entertainment. Losing money in the stock market is very possible. Stock market is at very high valuations right now. All right, everyone, I hope you enjoyed the Patreon exclusive video today. I wanted to go all out to welcome all of the new patrons here. I love you all. I'll see you in the next video.